So welcome back everybody for another webinar organized by Princeton for everyone worldwide. We're very happy to have Richard Thaler with us and Alex Imas. Hi Richard and hi Alex.
Hi Markus.
Hi Markus.
Today we talk about their new book, Behavioral Economics, Anomalies, Then and Now. And here's the cover of the book. It's a second edition. I think there's an earlier edition on the winner's course, which I read several years ago, or many years ago now. I guess the new part of it is then and now. You can test all the anomalies to what extent they're still holding after more than a decade later. And let me just, before I pass the phone on to Richard and to Alex, let me just classify some of the behavioral economics literature. In a sense, there's two big strands. One is biases. Bias can be in preferences. There's some reference dependencies, loss aversion, some anchoring, status quo bias, hyperbolic discounting, and so forth. And there can, instead of preferences, there can also be in the beliefs. You might have probability weighting, Kahneman, overconfidence, confirmation bias, gamblers and hot hand fallacy, and so forth. So the first tradition, I think there was a lot of emphasis on biases. And more recently, there's a lot of emphasis on noise. It's like a cognitive origin where the biases might be coming from. And people might be aware of this noise on their own. And it's often modeled with the drift diffusion models. So you learn the drift of these models. So it's like an information acquisition problem that everything is noisy, you get the information. Richard, of course, did also important work and is famous for the world of nudging in terms of paternalism. And you can do, overcoming biases, where you have some biases and preferences or beliefs. And, just exposing the agents or the citizens to the default option makes a big difference. And I still remember very vividly when we first time presented Save More Tomorrow, which, you just sign up for something tomorrow and you can overcome some biases this way. If you want to overcome some bias, some noise distortions, what you do, you nudge essentially people to expose them to certain information to overcome some of these noise components. Learn at a different speed or in a different direction. So with this, I think today we will learn more about the anomalies, which I think Richard and Alex have studied all their life, and I think they will show us today how well they hold up over the decades. So we're looking forward to it. And Richard, I think you're starting, and then Alex will take over subsequently.
So yeah, one small correction. The original version of this book came out in 1992. So, and it was based on a series of columns I wrote in the then new Journal of Economic Perspectives. So, the book was published in 92, and Alex and I started working on this new version at least 3 years ago. So it's like looking back 30 years and saying, should we throw everything away, or did we actually know something? Okay. So this is, Nobel Week, as our president seems to be keenly aware of. And let me cite two of my heroes who have that award. One is Danny Kahneman, in his book, Thinking Fast and Slow. I'm not sure he ever said this, but I'm putting words in his mouth. Maybe before you do something rash, check in with System 2, which is the slow part. But Bob Dylan has a famous song, Don't Think Twice, It's All Right. So who's right? And my message to economists is always listen to Danny. And I think we need System 2, and economists need some System 2. So what do I mean by thinking twice? We've made a lot of progress. It used to be, like when I first started causing trouble in the 80s, economists didn't think there was any other way to do things. And as Markus alluded to earlier, there's now a large literature on a large number of topics, like loss aversion, fairness, salience, hyperbolic discounting. These topics now appear in top journals. It used to be you'd have to justify, why are you introducing this? Now you can just do it and nobody really complains. On the other hand, textbooks have barely changed. If you open up a standard principles book, it looks pretty much like the ones that Markus would have read when he was a student, or even when I read when I was a student. So here are some. I'm going to give a few examples of things I think economists need to stop and think twice about. And the first, this goes back to the first paper I wrote that is a behavioral economics paper, published in 1980, before Alex was born. And it's think twice about the model you're writing down is a normative model or a descriptive model. And I think the big problem economists have is they've never clearly distinguished between these. So take expected utility theory. That was explicitly a normative model. And we had John von Neumann, smartest man on earth, or contender for that title, saying, look, here's a set of axioms that make sense to him, and you want to behave according to those, and if you do, this is what you've got to do, and you have to maximize expected utility. That's a normative model, but economists just also use it as their workhorse model of how people make decisions. So what's an example of the difference? Take Google Maps. That is a model of the fastest way to get from one place to another. And that's a normative model. But we might also be interested in, well, what route do actually people take? And let's show the next slide. That's a descriptive model, right? So that's what people do, and we might be interested in that. Maybe we want to put the sidewalk there or a hedge preventing people from doing that. So, but I think, so that's my first point, is that when we're writing down models, let's think about what we're trying to do. Are we trying to say, what's the smart way to do something, or what is the way that people do it? Okay, next slide. Now, a related point is think twice before you write down max dot, maximize. So I think economics really is distinguished from other social sciences because virtually all models start by agents, we don't even call them people, agents optimizing. And the study of markets, I think, is really what distinguishes economics from sociology and psychology. There's no underlying optimization going on. But, you know, we assume all agents maximize. And behavioral models might be called max but, maybe, you know. And so how seriously should we take the maximization part, and what's the alternative? And one first question people should ask is, well, how hard is the problem? Are we studying tic-tac-toe, where a bright first grader can solve it, or chess, where no human has yet solved it? Obviously, maximization is a good model of tic-tac-toe and a lousy model of chess unless you've got an app open in front of you. But if we're going to go down that path, then we need some way of measuring difficulty. So we know chess is harder than tic-tac-toe, but there are a lot of things we don't really know how to measure difficulty. So take the life cycle savings model, which is still the workhorse model of how people allocate their income over their lifetime. That's a really complicated problem. The only person I know who might have solved that problem for himself is Doug Diamond, who is one of the smartest people I know and is completely fascinated with these kinds of problems. So, you know, if I have a finance question, I go ask Doug. But for people who don't have access to Doug, it's completely preposterous that they're doing anything like figuring out the present value of their future income and simulating all the investment possibilities and then figuring out their life expectancy and updating that all the time. I once presented a talk at the Cornell Psychology Department and described this model, and the audience just started laughing. And thankfully, my friend Bob Frank was there and could assure them I wasn't making this up. It's not a caricature. It's a real model. Modigliani won the Nobel Prize for this. That's our model, and it's too hard. Nobody could do that. So
we could say that we have to have simpler models. So we can't go for these complicated models. Let's just represent reality with a simpler model, and then people can solve it within the simple model.
Well, I don't know. I think I disagree with that because, well, we don't know what the simple model is. So what you're saying is, okay, what do people do? Well, the Keynesian model is spend your income. Now, if you ask me, if suppose I have to choose between a hyper-rational Robert Barrow kind of life cycle model, where I'm not just doing that for myself, but for my heirs and their heirs, or C equals Y, I'll take C equals Y. But it's not that I think spend your income is the right model, but it's closer. And so my main point here is people are not capable of maximizing. We need to adjust for difficulty, and we have no idea how to do it. One thing I'm sure of is that how hard a problem is for a computer is not a good measure of how hard it is for humans. That's completely different. So what would an alternative model be? So Herb Simon, who was a behavioral economist before the term existed, liked to talk about satisficing models, which is you think about it and you choose something, and when you have a decision that feels good enough, you quit. He calls that satisficing. But I don't think we have good models of satisficing. And therefore, we don't really know how satisficing models differ from maximization models. And I think at the end of this book, we talk about some of these things. And I'm talking about this now because we're not going to get to it. But I think that is the frontier right now, or one of the frontiers, which is if maximizing models are clearly wrong, well, then what? And I don't think we have a then what yet.
What is this MEH? M-E-H?
I'm going to answer it, and then you can play the laugh track, Marcus.
Okay.
So, meh is, it's not right, it's not wrong, it's kind of meh. And that's the way, if I'm deciding how much time to spend trying to understand some paper I'm reading, I'm not maximizing, I'm doing something. And that's meh. So, and we don't have models of meh.
I see. So, you don't criticize rational expectations? That's maximizing also happens in models with deterministic outcomes, no?
Um, Not on this slide. I mean, with rational expectations, I knew you were going to talk about that
Okay.
before I started. So, and in a longer version of this talk, I talk about expectations. I think look, the Fed is preoccupied by expectations.
Yes.
I ask everybody I know in that area, whose expectations are you talking about? If you walk down the street in Princeton or on Michigan Avenue and you ask people what their inflation expectations are, they have no idea what you're talking about. They can answer the question whether they think prices are high or low and whether they have gone up, and they'll all say yes. But most of them won't know the difference between a rate and a level, much less what it means to have an expectation. Yeah, they think prices are going to go up because prices go up. So, I think bond traders have expectations, but who else? I don't know, and I don't even know whether we have a good framework for saying what loosey-goosey expectations are and whether they meet what we would call an expectation.
But would you agree that it's a useful benchmark? It might not represent reality, but it's one benchmark, and then we can describe the deviations from that as biases.
Yes, absolutely. Look, I think expected utility theory is a benchmark.
Yes.
Efficient market hypothesis. Gene Fama always teases me that behavioral finance would be nothing without him. He takes complete credit for the existence of behavioral finance and none of the blame for the mistakes we've made. But I'll give him that. You got to give him something, right? So I give him that. And it's like prospect theory couldn't exist without expected utility theory. And if we didn't have the efficient market hypothesis, we wouldn't have a null hypothesis. So yes, benchmark models are essential. But then if we claim to be behavioral economists, then what are we doing? And writing down a model, the rational expectations model, which is assuming that the market expectations are the same as those of the best econometrician, I think is preposterous.
Yes. There's a question coming in from Bill. He would like to know whether an AI assistant will overcome of these behavioral limitations once you can consult your private AI agent to help you do the life cycle smoothing of your consumption.
Alex.
I think
all hard questions go to the younger team member.
I mean, I think it's really hard to answer that question without knowing what that AI agent is. If it's just an LLM that you got, from just log in and start using ChatGPT, the answer is no. The LLM is trained on human data, which is biased, so it's going to give you a biased answer. If you prompt it and say, give me the unbiased answer, it'll give you some approximation that's closer to some benchmark, which, again, you don't know if it's correct or not. There's the black box nature of these agents makes it very, very difficult to answer this question in a concrete way. Even with the open weights models, it's just so complicated, like how the neural network is actually spitting out the output that it is. There's just no way to verify that the agent is actually going to be, solving the dynamic optimization problem in a way that we think it should be solving the problem. You could say like, hey, are the forecasts obeying fire or something like that? And what you probably realize is they don't. I've tested this in my own research. a lot of the time they're even kind of like asking them to do something very simple like maximizing expected utility. Unless you prompt it exactly to do the calculation, here are the numbers, here's what you have to do, they're going to give you something different. And the problem is, unlike with humans or unlike with a mathematical benchmark, you have no idea where that answer is coming from. So I'm not particularly optimistic about this.
And
Even going into the future. Sorry.
yeah, let me make a different point, which is there are results that are 50 years old that simple linear models do better than experts at virtually everything. So deciding which applicants to a graduate program are going to be best, to predicting which tumor is likely to be benign or malignant. And that's a 50-year-old result. That's still true. And in almost all the cases that have been studied, we haven't switched over to models. So we didn't need AI to get better predictions. Linear regressions make better predictions than humans. And of course, machine learning can improve, but will we use them? That's another question. So Alex is answering the question of whether that model will be as good as our assumed hyper-rational model. And there's a second question, which is, will we bother to use it? Mm-hmm. And I would say, yes, hedge funds are going to use it. But we use it when we're driving. The GPS is optimizing and telling us what the traffic is. But I've yet to be at a university that used models to predict students.
But can you imagine in the future we outsource our decision making to 90% to some AI agents, and we don't really make so many decisions anymore?
Yes, I can. I do. I let the GPS decide the best way for me to get home.
Yeah.
But I don't have it decide what movie I should watch. Now,
but some people might even let decide whom to marry, in a sense.
Yes, and for good or for bad. I mean, it's hard to imagine that AI would be worse, right? I mean, marriage, we seem to be about 50%
Yes.
on choosing spouses optimally. I don't, it might have been that the old model of having your parents choose a spouse was better. I see no evidence that it was worse.
But summarizing, could it be that in 10 years behavioral economics dies because all the decisions are made by some AI components? Or do you think
I just don't see that. Mm-hmm. I mean, again, it's hard. It's hard to make predictions, especially about the future, as a smart man once said. But there needs to be a kind of a revolution in the architecture of the AI that's not based on what we know now, as in the LLM. I have work with Sanjog Misra, and Kevin Lee, who are colleagues at Chicago, showing that even with AI agents, AI agents are supposed to be these kind of hyper-rational things that you just prompt it, they go out there, they negotiate for you. Everything's going to now be homogenous. Everybody's going to be getting similar outcomes based on the preferences that you input into the agent. Turns out that these agents, because they're built on text data, and anytime you're going to use the architecture of an LLM, that's what it's going to use, regardless of how you scale it. What we find is that basically you get the same sort of heterogeneity as you get with human negotiators, because the prompt is literally kind of injecting the preferences and biases of the humans into the agents. So, but now again, you have this black box nature that the heterogeneity looks kind of alien. You don't know where it's coming from. So you're not getting to like this hyper rational result from the standard model where like, look, you're going to just get, heterogeneity based on explicit preferences that are fed in through the prompts. You're just kind of getting alien heterogeneity that you can't really explain, where people are getting outcomes that they might not really be happy with because they don't have no idea why the agent negotiated the outcome that they did. And, this is the top flight models that we're using. And I think this is going to be a real impediment for the current architecture as far as getting anywhere close to being these universal decision aids where people kind of sit back and let them decide what to watch on Netflix, let them, pick their partners and things like that.
So just to summarize, these are two great questions, and we don't know the answers because partly we don't know whether those agents will meet those models, and B, we don't know whether humans will choose to use them. And we'll see. Good questions. If we ask who has good expectations, weather forecasters, perfect. CFOs of U.S. firms are asked to predict the return on the S&P 500 and 80% confidence limits. And how do they do? So this is the percent of their forecasts that lie within the 80% limits. And they should all be up at that dotted line at 80%. And you can see they managed to get up there 4 times in the sample. And in many cases, this is the percent of the forecasters that had a wide enough limit. And in some years, it's none of them. And this is like during the financial crisis. For years, the worst case scenario was 0. And obviously, we've had periods where the return on the stock market was below 0. So next slide. All right. Now, this is one where economists don't even really think there's anything to think about. So we write down some utility function, and we say, do people maximize that? And people think that, well, that's a tautology. And if you believe revealed preference, if that's kind of your approach, then we choose whatever it is that maximizes our utility. How could you disprove it? Well, there's another ancient literature documenting something called the preference reversal phenomenon, where it's very easy to get people to say that they prefer A to B and B to A. And this work was done in the 70s, and then David Grether and Charlie Pratt tried to disprove it and failed, and published that in the AER around 1980. But that hasn't stopped economists from studying utility maximization problems and assuming that they're correct. And a question that Danny Kahneman asked, and we have a piece, Danny and I have a piece in this book, which is, are people even capable of maximizing utility? And in order for them to be capable, they have to be able to make forecasts. So if I'm going to choose the dinner option that will make me happiest, I have to make a good forecast. And there's lots of data suggesting that we're not good at that. And so even, I would say, the idea that people maximize utility, which seems like it doesn't require thinking twice, I would say it does.
So, but what's the alternative? So if we have these inconsistencies that people prefer A to B and B to A, what should we do instead, in a sense?
Well, that's a good question. And I think that is the entire behavioral economics agenda, is to say, what do people do? And you know, that my little theme of thinking twice is even on questions that economists would think, well, come on, it can't be problematic to assume that people maximize utility. Isn't that what utility means? And, you know, we can disprove that quite quickly. The next slide is a good joke, and then I'm going to turn it over to Alex. In case you don't speak Spanish, Marcus, so this is a violation of the law of one price.
Yes.
Okay, I'm going to turn the reins over to
price
Alex.
discrimination for non-Spanish speakers or something.
Exactly. That includes Germans, Marcus.
What should I do? I'm happy to pay $5.
Choose the cheaper one. Probably even better.
So Alex,
Okay. Skip over to whatever. Oh, well, yeah, I guess this is another joke. On the law of one price. There's a closed-end fund called the Cuba Fund. It has a ticker symbol CUBA.
has anything to do with the country Cuba?
No.
Okay.
It invests in the Caribbean,
Okay.
but it has a ticker symbol CUBA. And it normally sold at a discount until there was this one day when it shot to a 70% premium. Now, remember, it has nothing to do with Cuba. And there are no securities in Cuba. And if there were, it would be illegal to invest in them. But any guesses as to what happened on December 18th of whatever year that is? That's the day that Obama announced his intention to relax relations with a country that happens to be spelled the same way
I see.
as this closed-end fund. So I'm done with my jokes. Keep skipping until Alex starts talking.
Okay, so that's a good segue to kind of talk about what we basically did with the book, as far as, you know, there was this original winner's curse in published in 1992, which basically took these anomaly columns that Richard was writing with his co-authors and put them together in a volume. And it's been almost 3 decades since that publication. So what we wanted to do with the book was to say, okay, so it's been 3 decades. What have we learned? Can we look back at the field and see where it is today? And one of the things that we add to each kind of a topic, which is kind of anchored around this anomalies column, is to show that, look, a lot of the research that was done in the past as a bedrock for behavioral economics, a lot of it took place in the lab, essentially. So student samples, low stakes, sometimes even hypothetical. So if you read the original prospect theory paper, all of the experiments were hypothetical choice. And a lot of the pushback by economists at the time, including in 92, was, look, we don't really care about what students in the lab do at these low stakes. Smart people are the ones who survive market conditions, and these smart people are just not going to display the biases that you're talking about and telling us that we need to be worried about. So we're just going to say we're not worried about it. So the part of what Richard and I argue is that part of the reason behavioral economics has become a successful subfield of economics is that the last 30 years or 25 years has shown that a lot of these anomalies show up in real world settings amongst exactly the type of people who economists should say these are precisely the people who shouldn't have these anomalies. So the last 3 decades has shown that the anomalies appear amongst professional investors, amongst professional athletes. Richard showed a graph on CEOs.
So you think the field experiments were the key new element? What about the neuroeconomics, finding neurocorrelates? Do you think it was also important to make the field mature?
So it depends on what you say about neuroeconomics. So I think there was a lot of excitement in the mid 2000s, I think 2005, 2006, about neuroeconomics, and about kind of going to that to the point where you can use neural data to do like that, what Edgeworth was talking about, this hedonanometer, where like you can actually measure utility in the brain. I'd say I was actually at the Society of Neuroeconomics conference this past weekend. It's still a huge organization. There were hundreds of people in the room. I'd say that the idea of using non-choice data to think about economic decision making, that idea is alive and well. And actually, I'll talk about this at the very end. That is kind of where the frontier of behavioral economics is now, is to think about the cognitive foundations for the types of things that we're going to be that make up these behavioral economic anomalies. So what is loss aversion? Is it really just a parameter we're adding to the utility function, or is this some sort of result of people's natural cognitive constraints being limited? So, for example, the fact that we don't have infinite attention, that we don't have infinite memory. If we put these constraints on people's attention, memory, and all of these other resources, can we get what looks like loss aversion? Can we get what looks like narrow bracketing? And I think the exciting frontier research in behavioral economics is showing that actually, yes, that's the case. That we can think about almost, thinking about behavioral economics through the lens of constrained maximization in some ways, but in a different way than the sort of the max utility that we've been thinking about before.
And for this, I can do still this with models. I don't need neurocorrelates. Certain parts of the brains are active or not active. Is this correct?
Yeah. So what I meant in the beginning is that we're still using neural correlates, but we're not necessarily using fMRI data.
Mm-hmm. Okay.
So people are still using fMRI data, but that data has become pretty controversial even in the neuroscience community, because just because something lights up, it turns out that that's not actually where it's happening necessarily.
Yeah. Well, one other thought about that, Marcus. Colin Kammerer has been a friend of mine for 40 some years. My challenge to him has always been, show me either something you've discovered that I didn't think I already knew, like that people are loss averse, or show me something I thought I knew is wrong. And I don't think he's been able to do either of those. But he's giving a talk in Chicago on Monday. Maybe I'll have to revise.
Okay, good. Let's go back to behavioral finance.
Yeah, and I just kind of wanted to end. I think on that note, I think what that line of research has been doing is allowing us to put more structure on something that behavioral economists and economists have been ignoring for a long time, which is context effects. Behavioral economists have kind of like not really tried to touch those formally for a long time, but what the empirical evidence shows is that they're actually super important, right? You can get if you look at data on even loss aversion, that data. There's a lot of heterogeneity on that data. So putting structure on when you will see some level of loss aversion versus a different level of loss aversion, I mean, we're talking about magnitudes. Putting structure on that is where I think the meat of this research program is going to be. So going back to behavioral finance is one of the most successful subfields of behavioral econ. And I think the reason for that is the fact that this is an environment where people are spending time on these decisions, getting feedback on these decisions. This is real money on the line, often thousands of dollars. And we've seen a lot of kind of behavioral biases being documented, sometimes even in the field before it gets documented in the lab, such as in the case of the disposition effect and overconfidence and things like that. But the pushback against behavioral finance which started with Richard's paper in '85, and then Terry O'Dean's papers in the late '90s, has also been kind of similar to the subjects in the lab. Look, a lot of the data comes from retail traders who might not know what's going on. They're a tiny portion of the market. It's getting larger with Robinhood, but they're still really small. They don't have a lot of money. So there's been a dearth of studies on smart money, and as a result, finance academics have still been able to kind of push back on this research, saying like, look, you have incentives, you have feedback, but this is still not the people who we're really concerned with. So I wanted to give an example of kind of where some of the research is today in behavioral economics. So I'm going to use my paper as an example, just because I know a lot about it. It was published in the JF in 2024, and I think where this paper is kind of placed in behavioral economics is that we're actually able to look at financial market experts. So we're actually able to get data on daily trade decisions, looking at the entire portfolio of these financial experts on a daily basis. So I have their entire access to the entire portfolio over a 13-year period. I know exactly what they can trade, and I know exactly what they do trade every single day. And because of this access to data, we can actually say, look, are there markers of rationality in these decisions, or are there markers of the sort of behavioral economic biases that we've been documenting amongst less sophisticated populations? And the question that we ask in this paper is a very basic one, which is that are buying and selling decisions, they're two sides of the same coin in standard economic models. Do they look similar in this population? So here's like a summary slide of the type of people we have in the data set. We have about 800 folks over a 13-year period. They have very large portfolios. The Odin data set, Terry Odin's data set, had about, the average market portfolio was about $10,000. In our case, it's $573 million. They hold a lot more assets. They have longer holding periods, and and because we have such a long span, we have a lot of trade data. Next slide. And just to give you kind of background, Matt Levine, some of you might be reading, covered this paper, and he basically said that we in our economic models we think these should be the same, but actually if you kind of talk to traders, there's some hints that these might be different. So he said if you hang around financial markets, you'll get the sort of advice about how to decide what stocks to buy, and almost all of this comes down to some sort of fundamental analysis. You're actually doing research about what to buy. You also get some advice about how to sell, but this advice tends to be heuristic. So something you hear is cut your losses and let your winners run. People say that. If you double your money, sell and take the profit. That's what Barron said in their handbook. The basic folksy rule of wisdom for buying is about fundamentals, but for selling, it's all about price action.
Is it all the disposition effect?
Not quite. Not quite. I'll show you what that looks like. Half of it looks like the disposition effect. So the question is, so we looked at buying and selling, and we because we have access to their entire portfolios and we have 13 years of data, we could actually construct counterfactuals for their buying and selling performance. So on buying, we can say, look, I can see what they bought. I can also see what they could have bought. Let me buy something that is matched on all of the characteristics that we can think of in terms of what they actually bought, and say, is there some sort of signal that they're acting on in terms of counterfactual returns? And what we see is that there seems to be some sort of skill in buying. They're doing better than this random counterfactual that we threw the boat at it. We have a lot of different counterfactuals in the data. All of it points to the same picture, that it seems like they actually know what they're doing for buying. Next slide. But in order to buy, because these are long-only portfolios, the portfolio managers actually need to sell. It's unfair to compare the counterfactual to the benchmark because they can't necessarily buy or sell the entire benchmark that the client provides for them. So what we do is we use a very conservative counterfactual, which is, I see you sell $1 worth of shares. I know you need to sell this $1 worth of shares. What I'm going to do is I'm going to throw a dart at your portfolio and randomly sell $1 worth of something else. And we have versions of this where we match to risk characteristics, matched industry, all of these sorts of things. So we call this a random selling strategy. And we see, do you do better than this random selling strategy? Next slide. And the answer is no. They're horrible at selling.
So are you saying that I'm just selling to free up some funds in order to really buy what I want to buy?
Yeah, they're selling funds to. That's exactly what they're doing. But even if they were selling randomly, that should be at zero, essentially. Yes. So they're somehow doing worse than random. So what are they doing? Next slide. A natural candidate for thinking about what they're doing is to think about the behavioral economics literature on limited attention. That people can't pay attention to all of the things that they need to be paying attention to. These guys technically can, because they can slow down, they have resources for analysts and things like that. But what we're arguing is that is exactly what they're doing for their buying decisions. But for their selling decisions, they're using some limited attention heuristic. So how do we find evidence for limited attention in the data set? Well, we can use, so here's the slide, we can use proxies for limited attention, namely, are they buying or selling salient positions in their portfolio? Salient meaning extreme returns on the winner or loser side. On the buying side, we find absolutely no correlation between prior returns and what they're buying for their portfolio. So they seem to be doing something we can't predict, which is why we're seeing skill. On the other hand, we can really, really, really predict what they're doing, what they're selling. They're basically mainly looking at, in the terms of the consideration set, they're mainly looking at these salient buckets of things that have gone down a lot or things that have gone up a lot, which is very salient on all of their screens, and basically choosing things from that. The reason that it tends to not, this strategy underperforms is because they're not just choosing randomly even from those buckets, they're selling something that they're least attached to, which is the endowment effect. And because the thing that they're least attached to are the things that they recently bought is actually generating them alpha, this is precisely what you shouldn't be selling. It's still generating them alpha. We could actually map the alpha curve and show that this is where they're selling and this is where they should be selling, which is much later. So that's kind of an, yeah, go ahead.
If you were to look at short selling, I guess the short selling would be like buying. If I explicitly go short a stock.
So we can't look at that in the data because they're not allowed to short.
Okay.
These are long-only portfolios. So think like pension
conceptually,
funds.
That's right, Markus. That if it were a long-short portfolio, then the short, it would be the initiations versus the closing.
Yeah.
And that's an interesting follow-up paper. Just give Alex the data from some hedge fund.
Yeah, I need some data. That's the problem with all of this.
One to Robert asked, is there some tax management? Did you take the tax management into account?
Yeah, we did. So these are all tax-exempt portfolios.
Okay.
Yeah. Okay, so so that's kind of an example of where the field has gone, which is, again, you looking at anomalies in field data. The other part that we wanted to do in the book is to look back and to say, look, these anomalies form the bedrock of behavioral economics. As many of you know in the audience, there's been a bit of a replication crisis in the social sciences where, you go out there, you replicate a bedrock study, and it doesn't replicate. And this is a big problem if you have a whole field based on studies that may not replicate. So a natural question we wanted to say is, do these anomalies replicate? So what we did in the book is we took the main experiment from every single chapter. We created instructions for it, basically mirroring the instructions that are available, and we ran it. And then all of this, as I'll say in a couple slides, all of this is included in the online material of the book, so you can actually do it yourself.
Experiments or field experiments?
The lab experiments.
Pardon me? Sorry.
So it's actually, as I mentioned before, the majority of the original anomalies columns were based on lab experiments.
Yes,
the ones that weren't based on lab experiments used publicly available data, and we did that too. So for example, the equity premium puzzle used publicly available data, so we just took that data and extended it through 2024 and showed that we find very similar results. This is what I just said, we ran all of these experiments on Prolific. And what we found is that the anomalies are remarkably robust. So this is the preference reversal phenomenon. So people are asked, they are given a choice between two lotteries. The one on the left has a fairly high chance of winning, but a low chance of losing, 50 cents. The one on the right has a low chance of winning, $40, and a high chance of losing. When people are asked what to do in terms of binary choice, they say, actually, I prefer the one on the left. 70% participants do that. But when they're asked their willingness to pay, which is what Richard alluded to earlier, they flip. They actually assign a higher willingness to pay. They value the one on the right higher. So this is the classic preference reversal phenomenon. We replicate that one. The dictator game, all of the social preference experiments, essentially showing, look, if I'm playing a dictator, if can divide money between myself and another person, I have $10. The other person are here 100 units, which translate into $10. How much do I give to the other person? Pure selfish model says I should give 0. This one, what the prior studies found, that people generally give 50%, and the minority gives 0, and we replicate that perfectly well. The ultimatum game also replicates very well. The endowment effect replicates really well. So you could say, look, half of you are given mugs, half of you are given mini artwork. This is a picture of the mug. Here's the picture of the artwork. Your choice, and then you're asked, do you want the other one? Basically, do you want to trade? If things were randomly assigned, Coase theorem says, it shouldn't matter what your random assignment is in terms of how much, what's the next thing you want. Turns out it has a huge effect on. So if people endowed with art, most of them want the art, they want to keep it. Those that are endowed with the mug, most of them want to keep the mug.
But did you also find one result which was not robust?
So the only result that we found that wasn't robust was, in prospect theory, there were 14 questions. Mm-hmm. There are several questions that show that the convexity over losses.
Diminishing sensitivity. Yeah.
Diminishing sensitivity. One of the questions was between getting 0. Sorry, the lottery had 0 as an outcome, and the other one just had two losses. Mm-hmm. And the lottery with 0 had a probability of a larger loss than the other one. So selecting it meant that you were risk seeking. We replicated that one, but then there was another question where both of the lotteries were in the loss domain, but there was no opportunity to recover, and that one we didn't find support. That was about a 50-50 choice, okay. But that was the only one, and that's been actually shown in subsequent studies that have been replicating the prospect theory questions. Is that essentially 13 of the 14 replicate really well, but that's the one that tends to fail to replicate. That's out of all of the ones that we've tried, that's the only one we found.
Okay, so you made a serious check of all the anomalies, and only this little one, it's not a first order finding, could not be replicated.
Yeah, next slide.
Yeah, and in fact, that's replicating a finding Eric Johnson and I had in 1990.
Yeah, so as I said, there's the risk seeking over losses is really driven by the ability to get back to 0. And
yes. Makes sense.
So all of this is available online, including the materials. So you don't have to trust us. You can download the materials, and there's actually instructions on how to do it yourself, how to run these experiments. Mm-hmm. We also include teaching slides if you want to teach any of the chapters or anything like that. So you can go ahead and take a look. So kind of taking stock, we kind of thought about how to frame this. And our view is that it's not really that surprising that the anomalies are replicating. Part of the initial pushback from against behavioral economics was to say, look, we don't think these are very robust. And so economists, like Richard was talking about, Charlie Plott and Grether, they took these instructions and they started replicating these things, and they found that they were robust. By the time Richard was writing the Anomalies chapters, most of them had been replicated already, and many of these anomalies are used as classroom demonstrations of behavioral economics. If in a classroom something kept being not replicated, that would probably, because of frequent replication attempts, chances are that this would come up. So I think this is a really
a very good nose to identify in the 80s and 90s already which anomalies are robust in advance. There must be some other anomalies.
I wasn't picking them at random, Marcus.
Exactly.
Yeah. So, but that's all we're claiming is that the topics I chose to write anomalies about in the 80s and 90s, those replicate.
Yes. Fair enough. Yes.
Yeah, and I think the other thing that we argue is that behavioral economics is very closely linked to experimental economics. These are two separate fields, but they're closely linked. And the methods that behavioral economics adopted were the methods that were in experimental economics. And experimental economics used methods that are quite different from psychology. One of the main things that they differs is that from the beginning, and since the 1977 Vernon Smith paper, is that all instructions and all the data were just stapled in the back of the paper. And because of that, when a lot of the time when a paper was published, it built on an existing paradigm. So one of the conditions was a replication of the previous result. So if you look at all of the bubble experiments that have come up in the AER Econometrica, they have a previous demonstration as a replication. And behavioral economics has kind of evolved in a similar way, where you say, here, I want to explain something about prospect theory. Before I, do the contribution, one of my control conditions is actually going to be the condition from the previous experiment. And the reason that I'm able to do that is because the people who had published the previous paper included their instructions and included their data. And that's been kind of a tradition that's luckily been kept up throughout the process, where it's kind of like it has the hallmark of accumulative science in some sense.
There's also a big difference between experimental economics and experimental psychology with regard to deception.
Yeah.
Can you say something? Is it experiments which involve deceptions are equally robust, or is it because economics focused very much on experiments without deception?
I honestly don't think the deception part is a big deal as far as replicability. I think it's a big deal as far as potentially a big deal. This is actually a controversy in the field. There's papers being written about if people think that they're being deceived, are they going to act differently? So this like poisoning the pool argument. Most of the papers I've seen have shown very little difference in terms of how people behave. And so I think it's an important norm to have, just morally, and potentially it has an effect. But as far as replicability, I think the biggest thing in experimental economics has been the tradition of posting your data and posting your instructions. And you still see that, you review a paper, and it's very common for a reviewer, such as myself, to email the editor saying, hey, they didn't include their instructions. Can you email the authors and send me the instructions so I can take a look?
What about that the instructions become too complex? But Richard was talking about, limited attention. If I have 5 pages, I have to read.
Yeah, this has actually come up recently in experimental economics. People worried about noise driving some of the results. Yeah. This is actually, you brought up an active area of research. This gets me to the next slide about what's next. Okay. What will behavioral economics look like in the future? And I think that's exactly right, Marcus, is thinking about what parts of experimental economics, economic decision-making in observational data are driven by responses to difficult decisions. How do you model difficult decisions? How do you think about the response to difficult decisions? One approach has been to say, look, they're going to be noisy, but that's actually not even a predominant response. A lot of the time people switch to using actually super predictable and stable heuristics. So the data actually looks less noisy as the environment becomes more complex. So it's a very it's a very difficult problem. But this, I'm visiting Princeton, and Liat, Pietro, and I are actually running a reading group for graduate students in complexity, trying to reading the literature from across the social sciences and trying to make progress on that. It's a open area of research that eager students can make a lot of progress on.
So let me ask. Let me ask a question about complexity. Do you have complexity measure? Because Richard started out with that. We can't really measure complexity. It's also, when the financial crisis happened, so some assets were more complex than others. CDO Square was more complex than a CDO. And, but Goldman Sachs probably is, if you were to go from modeling bottom up, would be the most complex because they have CDO squares and CDOs. Do you have any idea, do you have any suggestions how we could measure complexity of a situation or of an asset itself? Or is there something out there in the literature yet, in your reading group?
There's a lot of stuff out there. There's a lot of suggestions. But Richard actually, a lot of them draw on computer science. Because computer science is 20 years of literature on complexity. But as Richard said, these measures don't actually line up very well with how people perceive complexity. And I mean, if you give me 100 things versus 10 things, I'll say like the 100 thing is more complex. Those definitions align. But you have choices like the CRT where people get it wrong, which is the computer program would say like, look, a bat and the ball, one costs 10 cents more than the other. This is not a complex problem, but yet people get it wrong all the time. So there must be some element of complexity in that problem. So I think there are measures of complexity to answer your question, but we need a lot more research to show when specific measures of complexity maps onto the ecologically valid response to complexity and perception of complexity that people have. Because sometimes people view 100 things and they actually don't think it's complex because there's like a salient thing that they all look at and they're saying, I'm just going to go with that. This is actually a very simple problem.
And sometimes I only have to look at the problem from a different angle and suddenly it becomes non-complex.
Yeah, right. Exactly.
And that's the problem with trying. We end the book by saying we think a big problem is what is difficult. And we say, warning, that's a difficult problem.
That's a nice ending. Let me just ask, you said going mainstream, so that means behavioral becomes more integrated or part of the main canon. Would you also say that experimental and behavioral essentially becomes one field, or where do you see the big differences going forward?
Let me answer that, which is, I think the biggest thing that's happened to behavioral is that it's gone, okay, hold on. Alex, you answer that. I have to go away for 1 second.
Okay. So we think that, I say we because we've had this conversation a lot. Where I was going to end on with going mainstream is what Richard had talked about before, which is about the textbooks and how economics is taught. And in one sense, behavioral economics is extremely mainstream in the sense that there's, almost every top department has behavioral economics on the faculty. Behavioral economists are publishing in top journals. There's, that we're having this conversation. But on the other measure of mainstream, behavioral economics has completely failed, like colossally. Right? And that measure is what's in the textbooks that people use when they learn economics. And, apart from like little segues in some cases and, Leibson, Asimoglu, and List have a micro textbook that has a little bit flavors of behavioral economics. But on the whole, like the core of economics that's being taught is still very much what you and Richard came up with. In some ways, there's more game theory, obviously.
Perhaps it's because you need to understand the benchmark first before you understand the deviations. No?
That's certainly true, but I think in many ways, and I agree with you that we should, like, this is the earlier conversation, which I completely agree with. You need benchmarks, but at the same time, like, thinking about like moving on to the next concept after learning the benchmark, you might want to know how people actually behave relative to that benchmark. And that's not done. You just move on to the next benchmark and hope that somebody takes an elective that may not even be taught at the school. So when I went to Northwestern, there was no behavioral economics course. So all you walked away from as an undergraduate is perfect competition a lot of the time, hyper-rational agents, rational expectations. You go out and then you start thinking, that markets are awesome, which, I mean, they are awesome, but, there's market failure. And people are hyper-rational, so we don't need any kind of regulation on shrouded attributes and things like that.
Marcus,
Richard, do you want to come back to?
Yeah, Marcus, there's just, sorry, I had to step away for a second. When I first started teaching a PhD course in behavioral finance at Chicago, I made Gene's class a prerequisite.
Okay.
I will say he didn't make my class a prerequisite. But,
Because you wanted to shoot him down.
I just wanted people to be informed.
Very good. So what's next? Is the element of artificial intelligence by purpose not on this slide? Or do you think artificial intelligence will play a big role in behavioral economics down the road in the next 10 years?
So I work in quite a bit in AI research these days. Your colleague Tom Griffiths is doing excellent work at the cognitive psychology department. To be honest, I'm not quite sure what it's going to look like yet. I think there is a vision where, which you mentioned earlier, that behavioral economics ceases to exist because AI just kind of does all the decisions for us and it's perfectly rational. But I don't see that happening. And in the near future, I don't know what's going to happen in the far future.
But if you were to advise a PhD student who thinks, he wants to work in that space, would you say, that's too risky? Or that's something?
No, not at all. I think the intersection between cognitive science and AI is an exploding field. And I think one area that AI can potentially help us with, particularly if you're working with small models, which are interpretable to some extent, is eliciting how people perceive a problem, exactly about the complexity issue. Yeah. So you can, instead of like digging into a person's brain, you could think about approximately representing some part of the decision of the judgment process and thinking, can we elicit something useful here? This is an active body of research.
Very good. So I like that we ended up with the next elements. I think I'm gonna wait for the third edition. Probably it shouldn't take so long anymore, perhaps in 10 years.
When I came out with a new edition of Nudge, we called it the final edition.
Oh, I see.
We didn't do that with this, but every 30 years, I think I can confidently predict that I will not be part of the process.
You never know. Perhaps you made some big progress on the health side. Okay, thanks a lot. It was a pleasure and I learned a lot. And thanks for all of you for attending. And I hope to see you soon again for another webinar.
Thank you.
Thanks, Marcus.
Thank you, Marcus.
Bye.
Bye.